Hi traders, on today's video I'll be talking about chart patterns. I'll be showing us the basic chart patterns. These very few ones I call the basic are ones that if we have a very in-depth knowledge of them, we can be able to understand how these patterns are formed. We can be able to identify whether they are bullish or bearish and also see where the breakout lies. These breakouts are the essence of chart patterns. Trading breakouts could give us a reasonable profit because at every breakout of pattern there's always volatility. So having the knowledge of this basic few, it will expand our knowledge to understand whatever we see on the chart, whatever pattern or dimension is taking. We can be able to draw out lines, make a conclusion on whether this is going to break out to the upside or break out to the downside. And also know that patterns are the foundation of technical analysis. So moving forward, let's see some of these patterns and what they are talking about. The ascending triangle is a breakout pattern that is formed when the price breaches the upper horizontal trend line with rising volume. It is a bullish formation. Now look at it. This is the upper horizontal trend line and it connects the what? The highs. See where the breakout happened. Once price breaks out of this horizontal line, which is the resistant line, then we know that there is a breakout and we can make our entry. Prior, we have to consider other confluences. Now look at the ascension. The ascension here is the what? The lows, higher lows. It gave it the what? The structure. So this is what an ascending triangle would look like. And look at the breakouts where we could have our entry trigger. And going forward, let's see what it will look like on the chart. A chart representation. On a typical price chart, we can see something like this. This is a high, another high. This nearly didn't reach the horizontal line, and another high. Now the horizontal line is likely connecting the highs. Look at the lows. The lows are what? Ascending. So we always have to have this nice confirmation before we trade. Have this nice confirmation. So whenever we see something like this forming, we can actually start making our drawings. So this is what we could call ascending triangle on the what? Price chart. The descending triangle. Contrary to the ascending triangle, it is a bearish chart pattern used in technical analysis, which is created by drawing one trend line that connects a series of lower highs and a second horizontal trend line that connects a series of lows. Now look at it. The highs gets lower, the highs getting lower, while the lows keep maintaining the support level. That is why we can have this horizontal what? Support. This trend line here serving as what? Resistance. And as the highs are getting lower, technically or logically, we can say that the buyers are losing strength. The buyers are losing strength in the market. That is why we could have the market traded down or breaking to the downside. That is a sell pressure. Let's look at what it will look like on a typical price chart. We can see how the sellers pushed. The buyers were able to sustain the support level, but they couldn't get it to the previous high. The highs keep getting lower until there's a breakout to the downside. But in some cases, it might not break out to the downside, it might break out to the upside. But we are 99% confident or apparently sure that this pattern will play out. Why? Because of the structure which it was formed. It was formed with symbol of what? Weakness on the buy pressure. The buy pressure keeps getting weaker. So there is tendency that the sellers would actually take over the market. That is how this pattern was formed. But in some cases, in very rare cases, it will actually end up breaking to the upside. Very rare. So that is why we always wait for what? Breakout confirmation before we make entry triggers. The bull flag. The bull flag is a trend continuation pattern that enhances the extension of an uptrend. The price action consolidates within the two parallel lines, trend lines, in the opposite direction of the uptrend before breaking out and continue the uptrend. Now look at the what? The spike up in price. The bull run, very, very, very massive one. Now there was consolidation. That is where we cannot make our what? lines, trend lines. And this is serving as what? Resistance. This is serving as support. Once there is a breakup, there's tendency of trend continuation. And the confirmation is where we'll make what? Our entry trigger. Looking at the charts, this is what we would likely see. And we could call it a bullish what? Flag. The first run here is considered the flag pull. When it was consolidating, that's the body of the flag. And at the breakup, the trend continuation to the upside, where we have what? Our entry trigger. And look at some other instances, what the bull flag will look like. Look at the spike up in price. So it's a a bullish pattern, a very, very healthy one. So wherever you see it, and you're able to draw it out, and you can actually confirm the breakout, it's worthy of trade. The bear flag. The bearish flag is a candlestick chart pattern that signals the continuation of the downtrend after the temporary pause is finished. The temporary pause, when the consolidation happens. As a continuation pattern, the bear flag shows sellers to push the price action further lower. That is the confirmation of the what? The pattern. As you can see, there was bearish what? Movement in the chart. Look at the consolidation where we made our what? Support and resistance what? Lines. After which there's a confirmation breaking to the downside, breaking out to the downside. That is where we can actually make our entry trigger. Now going forward, let's see what it will look like on a typical what? Price chart. This downpour here signals the what? The flag pull. Look at the consolidation where we make our what? The trend lines, resistance, support, signaling the what? The flag body, the flag pull, the flag. Now, breaking out to the downside is a confirmation of this what? Pattern. We can make our entry trigger at the breakout. Entry trigger can be made at the breakout. Considering other facts, you have to consider other what? Market factors before you can make your what? Entry trigger. So you'll be certain that this what? Break out to the downside is gonna play out for a while for you to make good profits. The head and shoulders pattern. This is a chart formation that predicts a bullish to bearish trend reversal. It talks about trend reversal. The market started from a bullish note. Look at these highs. And there was rejection in price here. The market held support here, bounced and had another higher high. There was also a rejection. It went and sustained the support level again, but the next high was equal to this what? Prior high, to the previous high. So now these two highs, left and right, are considered the what? Left and right shoulders, where this high in the middle is considered the head, just like a human structure. Now the support it was holding becomes the what? The neckline, just a typical human structure. And this neckline, as you can see, is automatically the what? The support level. And breaking below this support is what? Confirmation of what? The pattern playing out, where we'll probably have our what? Entry, where we could consider making a short entry. This is what? Trend what? Prediction that a bullish to bearish trend reversal is about to what? Happen. Now looking at a typical chart, look at the left shoulder, look at the right shoulder. They might not be of exact height, but they will be nearly what? Equal. While the head will be very pivoted, it will be standing taller. Where we have what? These bounces. The bounces here as the what? The support level. And breaking below this support is a play out of this what? Pattern. So whenever we see something like this forming, we can make our drawings and be looking out. Watch out, watch it play out. Once it does, we can make our entry what? Trigger. Moving forward, inverse head and shoulders. An inverse head and shoulders is similar to the standard head and shoulders pattern, but inverted, just upside down, with the head and shoulders top used to predict reversal of downtrend to uptrend. Head and shoulders are used to predict reversal from uptrend to downtrend, while the inverse is used to what? Predict downtrend to what? Uptrend. The left shoulder the right shoulder, the head. Now the low, there was a low here, another lower low, then a low with the same level with the prior low. Now look at the neckline where the height gets what rejected in price. So now once we see a formation like this, we'll start waiting for what breakout to the upside. The breaking out of this what the neckline. Once there's a breakout, it's a nice confirmation that the price will what go much what higher, considering other factors. So an inverse head and shoulder is typically what a bullish what pattern, and it's not just a bullish pattern, it's a reversal from the bull to the bear to the what to the bullish what run. Now this is typical what it will look like what on a price chart. There was a dump to these lows, there was a spike up, and there was a rejection, another dump to another lower low. Now rejection at that same level, consider the neckline. Now the dump again here didn't get to this previous what low, so this low here is having the same height with this what this prior low here. So we can now consider this is inverse head and shoulder playing out. So at this point now, we'll start watching out for what breakout confirmation. So we can see how these patterns are being formed and how we ourselves can be able to draw out confluences on them and wait and watch to see how they will play out. So once there is a confirmation, one can make a long entry, considering other factors, most importantly. The double top. If you can navigate to Bitcoin price chart, Bitcoin USDT price chart on a monthly time frame, you will see something like this. The double top, where there is two price reach, two highs before the dump. Now, how is it formed? Now, let's make a definition. A double top is a bearish reversal pattern that forms after an asset reaches a high price 2 consecutive times. With a moderate decline between the two highs, it is confirmed once the asset's price falls below a support level significant to the low between the two prior highs. Look at the first high, the second high. Look at the support level where it bounced before forming the what next high. I think Bitcoin BTC USDT price chart, the neckline there, which is the support level, was at 35. Breaking below it was a confirmation of what double top. So you can rightly see this pattern on BTC USDT monthly what time frame. Now look at what it will look like on a typical chart. You can verify with the price chart I just suggested, BTC USDT monthly time frame. You can see here, right? The first high, the second was high. There was a drop to this level and before the bounce, and coming back to this level and breaking it, breaking below, is a confirmation of what the pattern, and more like where you have your entry trigger with other factors in play. So this neckline is also what the support level. The double bottom is just an inverse of the double top. A double bottom pattern is a charting formation that represents a major change in trend and a momentum reversal from a prior down move in market trading. It describes the drop of price, another drop to the same or similar level as the original drop, and finally another rebound that may become a new uptrend. What does that mean? A drop in price, there was a bounce, another drop in price to that same what, almost that same low, the level. Now the rebounds, breaking this what, this rejection in price here could now take us what to the upside. We can anticipate a bull run. It's more like a reversal from the what downside to the upside. Now this is what it will likely look like on a typical chart. The first low, the rejection in price, the second low, the breakouts of resistance. So this is double top, an inverse of what double bottom. Sorry, this is a double bottom, an inverse of what double top chart pattern. So this will be the last chart pattern I'll be talking about on this video. Subscribe to the channel, like this video, comment, and make your recommendation. Thank you very much, and see you next time.